Welcome to Level Up Real Estate Investing Podcast with Robert Heyder. This is a no-fluff podcast where we dig deep into the journey of scaling your real estate investing and wholesaling business and discuss how to break into commercial real estate investing. Robert Heyder here with Level Up Real Estate Investing Podcast. For those who don't know me, I'll go through my journey a little bit here. I grew up in St. Louis, Missouri, lower middle class family, first member of my family to traditionally go to college. Out of college, I got into commercial real estate finance. It worked out really well. I was one of the youngest vice presidents of commercial real estate lending in St. Louis at the age of 25. During my time, I underwrote over $1 billion in commercial real estate deals. And then transitioned into full-time entrepreneurial real estate investing in 2013. When I got into real estate investing personally, I focused more on real estate rehabs, did some rentals and wholesales as I was trying to learn the wholesaling game. I quickly realized that the wholesaling side of the business was more scalable, focused on that heavy, and over the 6 years had exponential growth. In 2019, we will have purchased over 200 houses for wholesale, as well as running a real estate brokerage that'll do 60 million plus in transactions. We started and have since sold a residential property management company. We made a big transition into commercial real estate deals. We own and manage over 110,000 square feet of commercial space, as well as 60 plus residential doors. And the reason I go through all this for you guys is to get into the mission of this podcast, the real reason that I'm here. This is for next level thinkers. We're going to be talking about the newest ideas, the most innovative stuff. We're going to be talking about the 1% and 2% difference, the it factor, the edge, the stuff that really makes some investors great while other investors fail. We're going to be digging deep into work-life balance, mindset. We're going to be having interviews with some of the top folks in the industry, both in the residential and commercial real estate investing sectors. As well as high-level finance guys, maybe even tech guys that have scaled big businesses. If you want to be the best investor that you can be, and you want to get opened up to folks that are doing huge things, how they think, how they make decisions, how they process data, you're in the right spot. The Level Up Real Estate Investing Podcast here. Rob Heyder, your host, here with Chris Naugle. Really excited. I think it's going to be a really interesting show. Lots of high-level finance stuff being discussed. A little bit of backstory on Chris. Got into real estate investing in 2006. Started kind of pushing, doing rehabs and stuff. Started getting into commercial investing in 2008. Was building up a multifamily portfolio. Kind of got stuck in a bit of a vice. He'll dig into that. It's a pretty interesting story. Some big takeaways from that. Was aired on HGTV with Risky Builders. Pretty awesome feat to have that be in his quiver, in his sheath. And then really was kind of getting into rehabs and rental properties, the BRRRR model. And then more so recently, which is really exciting, he has founded the Money School and Money Multiplier, which are two kind of educational platforms as it relates to how money flows. So we're going to dig into that in pretty good detail. And as well as running a good-sized real estate investment company that does a few flips a month, some wholesale deals, and he also owns 50-plus rental properties as it stands. But he's got some interesting concepts on kind of what direction he's going with that. So without further ado, Chris, what's going on?
Not much. I'm excited to be here. Thanks for having me on the show.
Absolutely. Thanks for being here.
Yeah.
Well, cool, man. So did I get the timeline right?
Yeah. I mean, it's like we talked earlier, there's so much stuff. It's just like, I don't even, how do you put it all together? It's sort of almost just as we talk, I'll kind of just tell you the story and how it all worked.
Perfect. Yeah. So, I mean, it's really interesting, obviously like anybody that's been in this business that got started in the kind of rehabbing realm, it's just a constant struggle, a constant learning curve. Even when you think you've got it under control, you get hit with a whole new round of issues, or you start to scale up and do more units, and then another onslaught of issues occur, and you've got overhead and other variables that come in that kind of have a drag. So you can make money on deals, but still, have a loss for the month or the quarter because, you've got outside stuff and all of those variables. So not to say that was necessarily the case, but but I'd love to kind of hear a little bit about it. It sounds like, and knowing you for a little bit and then kind of discussing it beforehand, you mentioned that at some point you had 20 plus rehabs going at a single time.
Every month we had 20 to 25 going.
Which is unbelievable.
No, it's insanity. Do not repeat that process.
Don't do it. All right. That's the takeaway. That we've had 5 or 6 or 7 going at a single point in time, and it's brain damage. I can't imagine having 20 plus. I mean, that's insane.
It was hell. I don't even know how else to describe it. Some people would be like, "Oh my God, that's incredible." No, it's not. I mean, we had a huge crew. We had over 100 people at any given time, going at it. We had project managers, we had GCs, we had the whole gamut, plus a whole team here because we have an 8,000 square foot facility here, and this stuff's all just going. And just think of it this way: imagine having to write checks every week to pay over 100 contractors. Just think about the magnitude of that. Imagine having to carry all of those properties, including the hard money loans and the private money loans. And then imagine just paying the freaking utilities and tax bills on all of that. If that doesn't make you just sweat just thinking about it, then there's something wrong with you and you need psychiatric help.
I mean, so you've got thousands of checks going out a month.
Yes.
You've got 20 something properties going. You've got hundreds of contractors. You have interest bills, you have insurance bills, tax bills, utility bills. I mean, that's just an insane amount. Like I said, we've had a handful going at a given point in time, but 5 times that's a whole different story.
I would come in on Saturdays and all morning Sundays and I had a staff too. So I'd have one of my staff members come in and help me, and all we would do is literally as fast as we can pay as many of these bills. Now, a lot of people are like, well, why didn't you outsource this? If you think for a second I didn't try to outsource this, I went through 5 bookkeepers inside of 4 months trying to find them. They couldn't do it. They just physically, they said they could do it. And then they saw it and they're like, oh my God, I can't do this. There's no way. My mom's sick, or my kids need this, or there was always an excuse. So when it all falls apart and there's no one else, who's left? Well, the guy at the top of the mountain, right? Yeah, that's me. And that was what I had to do. You got to do it. Otherwise, all work halts. Contractors don't get paid. Utilities don't get paid. Taxes don't get paid. Bad things happen quickly. So we came in and there was just stacks, and we had a system, but it didn't matter. It took all day long just to pay bills. And you don't make any money paying bills. And do you know how disheartening that is to just continually keep paying bills? Yeah, sure. You got 20 flips going. So eventually you're selling all of these, but you know how sales go. You got peanuts. And then there's always things that come up on the peanut, and deals fall apart, and banks commitments don't come through. Anyway, I'm getting cold sweats just thinking about it. So let's go on to a different topic, because that was just a crazy period of time. And that was right when we had our HGTV show going.
Right.
So obviously that's kind of what was fueling all of this. We had our show, we were doing all these properties, because if you're going to have a show, why not be the king of the show, right? And practice what you preach. But we just went a little bit crazy. And a lot of people say to me, why did you buy so many? Well, if you had unlimited money at your disposal, then I shouldn't say unlimited, but more than enough, you could just basically dial a number and you had money to fund your deals, because you'd built that credibility and you'd figured out how money really worked. When you had a good deal come to you, you just bought it. And then any of the deals that you brought them in with the first intention to always wholesale them. But I never really did a great job with wholesaling, because in the back of my mind, I'm always like, we could just do this deal, So I'd bring it in, I'd try to wholesale. We did, we wholesaled a lot of them. And then, but if they didn't wholesale, we never canceled the contract. We're just like, well, we put it under contract because we thought it was a good deal, so we'll do it. And that's what we did.
Yeah, absolutely. We ran into the same thing, right? Because it sounds like your business model was very comparable to our business model in the past, where we did a fair amount of wholesaling, but we also had a lot of rehabs going on, and we bought a lot of properties for rental. So when you have all of these exit strategies, which is a benefit, right?
Exactly.
That is an advantage from you on a market standpoint, but it also creates all of this friction, because you don't just bring the deal in and then sell it off like most wholesalers. You say, well, maybe let's rehab it, well, we can make 2.5 times as much if we just rehab it. And it's probably a pretty easy rehab, and you convince yourself that you can, and there won't be any issues. And then you just go. We got the staff, we got this, it's close to this other deal. And, you can make sense of it.
And then the second exit comes, well, if we can't flip it and make 20%, well, then we'll just rent it. We'll put it in the rental portfolio. And that rental will then help us support even more flips, because then the rental supports. See, the one thing, I tell people is this all sounds pretty chaotic, but the one thing I will tell you is I'm very organized. I have a very good team and a lot of systems and processes. Obviously, you have to. So we always made sure, and I tracked this like a freaking hawk, that our rentals and the rental income that came in, the gross rental. So this is one mistake that you should take away from this. Our gross rental was always more than enough to support all of our carry costs on our flip portfolio that we were running. However, gross. Right. Now, even if you netted it down, it was still close. Like it would squeak by almost on its own. And then you had a couple flips or wholesale deals that would carry that spread. But then what happens when one of your sewer lines backs up at your rental, right? And that's a $5,000 dig. Well, you didn't budget for that. So when that happened, it's just like that one little thing. You're like, all right, we can absorb that. But then the next thing and the next thing, and eventually you start figuring out, holy crap, this is bad. And then you have to basically, you start leveraging properties. So then you start going to the bank and refinancing properties just to pull capital, just to keep up the float. Not refinancing to go like take a vacation or go to Cabo or do something fun. I'm saying taking refinances just to keep this machine working.
Yeah, you're stuck in the hamster wheel of your own business, not of working for the man and doing this, but it's your own kind of, you created this labyrinth that you have to keep going. And it's just,
I created the worst possible job you could ever create in your life. If you can picture being like a sewage guy, right? At the worst level of a sewage plant, going down and getting dirty and that stuff. That's kind of what I felt like my job was, but I created the monster. Mm-hmm. So I've always been like, I've always been an A-type and just a very much so an educated risk taker. Back to when I was a pro snowboarder, you got to be somewhat crazy to do that in the first place. Sure. So I was always never fearful of losing it all. So that was the first thing, because I figured if I lose it all tomorrow, I'll start over the next day, because I had the knowledge. And the one good thing that comes out of all that, is I learned so much at such a rapid pace. And I read a lot of books, but the one thing I'll tell everybody is everybody's afraid of failing. And I'll tell you that every single failure I had, all those things that I was just telling you that I was learning during this process, you could never, ever, ever pay enough money to learn what I learned in those 4 years of doing that and running that mad, freaking crazy business right there. I learned so much that catapulted everything else that I've been doing in my life.
Yeah, it was a pressure cooker, right? Just accelerated everything you could ever do. You know exactly what to do, what not to do. You know all of the issues that can be thrown at you because you're at such a high quantity so fast. And you know where the holes are really quickly. I mean, you figured that out fast. I mean, we were in the same boat. Our backgrounds are so comparable. It's interesting as we kind of talk. But as you're going through that, you're going through this pressure cooker. You're dealing with all of these headaches. So what are the 2 or 3 biggest kind of ahas that came out that you said, okay, here's where we need to be focusing. We've got to make a shift. We've got to make an adjustment, so on and so forth. Because during this time, you also had your investment practice going. Your actual,
I was
actual advisor.
Practicing, stockbroker, financial advisor, they're kind of one and the same in this day and age. But I had a very successful financial advisory business that I was doing. I was just very fortunate. Remember, since 2009 or 2008, if you will, we've been in a bull market. So as this is all going on, the markets are just cooperating. So outside of the Euro crisis and some other things like Greece and all those things that happened, my portfolios were kind of just steaming along, and I was making changes. I'm a very early riser, so I'd get up real early in the morning, go to the financial firm, check portfolios, make trades, do everything that I needed to, make sure it was done. Plus, I had a good staff, and that thing kind of just ran itself, and I made great money doing that. So, but I was doing that. And plus, you remember in 14, I started my own education company, and that in 15 was rolling, and 16, 17 was really rolling. So I had that going on. So I had students I was coaching during this whole thing. But that, when all this craziness was going on, coaching students was super easy. All I did is I just took them under my wing and I took them out to my jobs, my projects. I showed them, I literally taught them everything that I could teach them by just bringing them with me and doing that. It was so unbelievably valuable for them that we had a 97% success ratio for our education company, which I stopped taking new students in 18. And so there's a lot going on, but you're right. That pressure cooker brewed so many things. But you asked me what the biggest takeaways were, and I'll tell you there's two of them. First and foremost, the one thing, I was always good at money being an advisor, but I was good at money as an advisor: stocks, bonds, mutual funds, ETFs. I had no idea how money worked in real estate, or really how money worked at the millionaire level. So during this process, all the people I was working with, the lenders that were lending money to me, I watched and observed how much money they were making off of my deals, off of this madness. And I watched how little they did. They analyzed the deal, right? They put the structure together. And then after that, once the check was given to me, that was mailbox money for them. And I started hearing the terminology of, the ultimate in this business is being the bank. And I was like, someday I'm going to be the bank. But at that point in time, being the bank to me meant I had to make millions of dollars. And once I got millions of dollars, I can loan millions of dollars out.
Mm-hmm.
But I failed to realize the number one thing that was right under my nose. And that was, do banks actually use their own money? Hell no, they don't. They use everybody else's money. And that's what these people were doing that were lending money. That wasn't their money they were lending. Even though they were multi-millionaires and some of them were billionaires, they were not using their own money. So my aha moment was like, I got to learn how money really works. And I did. And I learned because I was failing in some things and I was succeeding in others. And I put two and two together. And then that's when it really kind of started brewing that desire to go back into money and really, really go into it at a very high level, because I had all these connections. When you get an HGTV show, literally you meet some really cool people, some very high level people. And these people, I was just saying, what do you do with money? What are you doing with your money? How are you making money, or in all these things? And none of them were investing in stocks. They weren't. They were doing alternative investments, things like what I'm talking about.
Sure.
And that's what brewed the whole thing. So that was learning lesson number one. Learning lesson number two was, if you are trying to get into real estate and you focus on scaling and building your business, the number one thing you better figure out really freaking quick is process and procedure, because I didn't have that in the beginning. And I tell you, if I could have went back and started that process over with what I know today, it would have been a completely different operation.
Oh, 100%. Right. And you would very quickly realize, hey, this is where the break is. This is where where we really make money. This is kind of where it's just, just doing it to do it. Right. And then kind of scaling into that. And then doing that quantity of deals and paying all those checks. And I mean, you hit the nail on the head. It's just writing all those checks aren't making you any money. That's just a part of having to do it. Right. So, you're evaluating what points in that process are that fall to the bottom line, and which one are just expenses that have to be done to kind of push this thing through.
Right.
Well, that's I mean, crazy exciting. Kind of hearing about all of that. I had a really good
I'm thinking back and I'm just like, it was exciting, but man, was it nuts. Oh.
Yeah. But I mean, like you said, the amount that you learn and how quickly you learn it is there's nothing getting past. There's nothing else that can provide that amount of knowledge to have it stick.
And I was failing. Don't think for a second, all those houses I was making money on, I'd lose, a couple of them I'd lose 40 on, I'd lose 5 here. And that might not seem like a big deal when you're doing that amount of volume, but when you lose 40, that means you got to do 2 more flips just to make up what you lost. And that was also kind of starting to come real. So what we actually started doing is very quickly taking properties and we developed a system. We said every property that comes through our funnels is always we're going to try to assign it. First and foremost, no ifs, ands, or buts. Assign or double close it. Yep. Secondly, we're going to see, can we flip this and make 20%? And if we can't, immediately that property went over to be a BRRRR. And then we would do a different kind of renovation with a different crew, and we'd take it to the bank halfway through, start the process of the refi, and that would now be a rental portfolio. And that's how we scaled our rental portfolio to, I think we went, before I started selling it off, we were upward of, almost 80 properties, which doesn't seem like a lot, but you got to remember, I wasn't dealing in commercial. I wasn't buying big apartment complexes because I thought that was too speculative, and I still do today. So I stayed away from it. I always loved the nimble aspect of singles to 4 units. If I needed liquidity calls and I needed money, I could easily sell one property and I was liquid again. If I had one big 100-unit building and something went wrong, where am I going to get liquidity? Right. So I stayed away from commercial at that point in time. I was in commercial in 2009 to 14. And from that point on, it's always been singles. So that was a lot of singles, doubles, and quads.
Well, yeah. And it's one thing to go out and yes, that's a huge point, right? To go out and buy an 80-unit complex is one thing. Having 80 singles, 2 families, 4 families is an entirely different story. And the other variable to that is buying them and getting them made ready and then re-tenanting or tenanting them
Yes.
is a whole nother story. So to buy 80 single families, multis, small multis, it is a piece. But obviously doing it the way that you did is a much more complicated process, right? So
Yes.
it's like, and because I say this because we made the exact mistake. We stepped in the same freaking mud puddle 20 times over, where it's like, okay, well, yeah, we're buying it really well, and we already have this crew. We can get them to rehab it and get it cleaned up a little bit and get it tenanted, and then okay, in 2.5 months, we'll kind of start getting a check, and then as you know, the first month or two you put a tenant in, that's when they have all the little things that they find. You're sending the maintenance
Oh
guy
yeah.
over, it's like month 3 of occupancy is when you really start to get some consistency.
I still deal with that today.
Yeah,
Absolutely. You're darn
absolutely.
right. I've got it down to maybe a month. Usually we're pretty good where it's about a month of rent goes to those nitpicky little things.
Oh yeah. But that, they're calling over that time. But so as you're kind of going through that, you're saying, okay, well, now you have this period of time where you aren't getting rent. You also bought the property. So you're going to pay all the loans, pay the contractors, all that, but you're also not getting your rehab profit because it's going into the rental portfolio,
Mm-hmm.
which is detrimental to keeping a business going. Because yes, it's great that you had enough rental properties to cover, a majority of your carry costs and kind of general overhead for the rehabs and whatnot. That's one way to look at it. But at the same point, it's like, okay, you're not ever seeing that to the bottom line. It's like, okay, you take this property offline that you would have got a 20% return on. Maybe that makes you 25 or 30 grand in rehab profit. Well, now you're getting $1,000 a month or $900 a month. It takes a long time to get that. And we used to do the
Absolutely.
exact same thing. So I say that not as a, not saying, hey, that's not the right model, just saying that we tripped into that same hole. Cause it's like, oh, we're already here. We've got this property. Great. We said we were going to buy it. We can do all this. We can get it up and going. It'll be better than if we just went out and bought a unit that was already rented and blah, 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 blah. But what I didn't account for at the time, and as I look back was an error, is the opportunity cost of having
Correct.
that purchase and my crew out there doing a deal that would actually bring money to the bottom line immediately versus just having maybe another $10,000 in equity or $15,000 in equity in that property that I wouldn't have otherwise. And for us, we were a little bit more conservative. We weren't pulling as much cash out. We were just kind of leaving it be. So there's equity in there. We'd leave the equity in there. So we truly had to wait for 4 months, 5 months after rehab, tenancy, getting through the little nitpicky stuff. And then the check finally starts to come
Mhm.
for the rents. So, I mean, that's a long buildup to get to some actual income coming in from that property.
I'll say the one thing we did really well. So if I look back on that whole period, when I started figuring the money piece out and I started really learning it, because it wasn't hard for me to figure out with my background, it's money's money. I mean, and you can get as creative and you know how to leverage it. So what I started figuring out is I developed systems, and those systems started with how much we can pay for a property. And I had a hard, fast system. If I couldn't buy it for this price based on my formula, I didn't buy it. But if I bought it for this price, first off, I probably should be able to wholesale it. But if somebody kicks tires and that, I didn't try too hard to wholesale. And then if I bring it into the flip and I try to sell it for 30 days or we go over budget, I knew without a shadow of doubt, because I'd already run the numbers in reverse order. And I ordered appraisals on every property, third party as complete appraisal. So I knew what the thing was going to appraise for. I knew if I took that deal to my community bank, which I had a $4.4 million limit, I knew that I would be able to pull cash out of every one of those deals upon refinance. And I knew it's almost to the penny how much that refinance was going to net me. So, you talk about flipping, and this is just the Burr model, folks. This is nothing more than the Burr model, but it's the Burr model done right with systems. So every time I'd take that deal to the bank, and I never would wait till the deal was done. I had such a great relationship that I'd built with this bank, and they trusted me that I'd bring the deal to the bank halfway through renovation with a really detailed scope of work. The appraiser from the banks, whatever one it was, I'd give that, and they knew our work. We already had demonstrated our credibility. They would have give us good appraisals even before it was done. So by the time the property was done and rented, even sometimes before, the bank was giving us that money. So I was almost doing almost the equivalent of a flip, right? Because at refinance, I was taking 10, 20, sometimes $30,000 checks that would be the same as a flip. But the one thing I didn't do is I never lost the unit. I never lost the asset. The asset was still in our portfolio, turning cash flow. I had zero money out of pocket, not a penny. It was all the bank's money. Even though I was leveraged 80 cents on the dollar on that property, which has its own risks, I was leveraged, but I'd already cashed out. I had a cash flowing unit here, and then I could turn and sell that, which is what I've been doing now. With the market being as high as it is, what we've been doing is identifying all the opportunities in our portfolio. And this is kind of silly. And, I learned this from Kent Clothier and Chris Clothier. I took all of our portfolio and I said, what do we got here? In Buffalo, we got great returns on investment. So I package them together, 5 and 10 unit packages. I take them, I put an ROI on them and a cap rate, and I send them off to California, New York City, and Toronto investors, and they salivate over these things. Fully rented, fully renovated properties that have double-digit cap rates. So what we started doing is just selling portfolios. And that's kind of what's taken me from almost 80 rentals down to, I think we're at like 53 now, because that's all I did. I just started selling packages. High profit packages.
So two things. Were you calling it the Burr model back then, or did that come along after?
After.
Yeah. I figure everyone's jumping on this Burr model thing like it's a new concept.
Did I tell you that I searched and seen if the Burr model, like the actual acronym of it, was trademarked, and it wasn't? So I went and got the trademark on it.
No, I didn't.
So I officially am approved now and have the trademark on Burr.
Nice. Yeah. Well, good for you, because someone should do something with it. Because I was like, all these people are talking about this damn Burr thing. I'm like, it's a cash out refi. That's what we're talking about, right?
That's all it is.
I mean,
and I didn't know what it was back then. I think Bigger Pockets, they coined the name. So I didn't come up with the name. I just was smart enough to get a trademark on it. But they came up with the name. I'm like, that's a really sexy sounding thing. And I just ran with it.
No, that's awesome. Well, cool. So, and then when you were actually doing the cash out refis, were you simply cashing out your initial investment, or were you actually pulling additional proceeds above and beyond your investment? Okay.
Oh, almost always additional. Yeah, that's what I mean. Like that 10, 15, 20 grand, that was just fluff. That was like taking the profit out.
Interesting. Okay.
Yeah. No, we were taking more. We'd pay the investors out. Obviously the bank paid the investors off, and then whatever money we had, we'd pay ourselves back, and the rest was just pure profit.
Investors being your finance folks.
Yeah, we had tons and tons of private investors we worked with.
Okay. Yeah.
That's one thing.
But they were mostly on a debt basis?
Always.
They were on a debt basis. Okay. So
I never liked partners. I never want someone else telling me what to do with our properties.
Got it. Well, cool. Okay. So that was that. And that makes sense. Everyone's kind of got a different concept on that. And we certainly have done it a few times, but we try to steer away from that to some degree. But especially in markets that are popping. So you can take some chips off the table, do it, right? Well, cool. So you're doing that. I love the idea. That was a big takeaway of packaging the properties up in 5 and 10 unit parcels, or 5 or 10 unit kind of packages, and then marketing them out. That's a really cool concept.
When you do that, it no longer becomes about the price per property. It becomes about the return and the cash flow. So literally I'd go and I took my appraisals. I priced these properties right at the full market appraisal, and I got it. No one ever really, every once in a while they'd beat me up on 1 or 2 of them and I'd reduce the price, but man, it was just like full price. So picture being able to take every house you have, selling it on the market, sometimes cash, no realtor, full price. Right. That's what I was doing, because I wasn't selling the property. I was selling what the property provided. I was solving people's problems, which their problem was cash flow. Most people, like, they have a lot of money. Their problem isn't like having a lot of money. Their problem is, what is their money going to do to make them more? How are they going to make their money go to work? So I provided a solution to show their money, the little marching greenbacks, how to actually go and work harder.
Well, and a majority of the time, the folks that actually have money, they're going to pay at the higher price points. They're not looking to spend or, buy properties at 50, 100,000, 150,000 at a pop. If they can put that money out in $500,000, $1 million, $2 million. Yeah. They want to put it on bigger tranches. So, packaging together like that is a great concept.
And who does that really well? Banks. A lot of what I've learned is just by mimicking what the wealthy do and what banks do. Because, you just follow the smart money, and then you can really see the clear path to what it's doing, which now what I'm doing is I'm really, really studying these iBuyers, because at first they made no sense. And now it's just like the light bulb went off and I'm like, I know exactly what they're doing, why they're doing it, why nobody can make sense of it. And it's brilliant, but it's kind of silly too at the same time. And like, I'm getting ready to do the same damn thing.
Let's hear about it. What are they doing?
Well, it's just Wall Street money. So a lot of those big I buyers are hedge funds or combinations of hedge funds and big money, all flowing out of Wall Street. So a lot of them know, smart money knows that the markets are not probably going to continue like this. I mean, look at Warren Buffett. He's sitting on, last I checked, I think 128 billion in cash. Warren Buffett doesn't like cash. He doesn't want cash. He's got nowhere to put his money. So he's sitting in cash waiting for an opportunity. So all this big money is flowing out of Wall Street, going into these hedge funds. These hedge funds have hundreds of billions of dollars, and they don't know where that money's going to go. They don't want to reinvest in the markets. So what they're doing is they're finding the next best thing: tangible assets, real estate. So what they've done is they've, just like Zillow and all these other ones, they've figured out that the money in real estate isn't on the front end. The money on real estate's 3 levels deep. So they're buying these properties, and then they also own the mortgage companies, or they have connections with the mortgage companies. So the mortgages are cash cows. So what they're doing is they're buying these properties full boat, reselling them, not making anything on the sale. Imagine being able to flip houses, but not caring if you make anything, or even if you lose 10 to 20 grand per property, because you're going to make it all 3 times deep. You're going to make it on the mortgage. You're going to make it on the fees from the mortgage. You're going to make it on everything else behind the scenes. Well, that's what they're doing, but it's all Wall Street money. So it's just money that's flowing out that is either going to sit in cash or sit in real estate. They've got the appraisals to support the valuations on a balance sheet, so they look like freaking geniuses when you look at them on paper, because they've got all these assets worth all this money, and all they do is they basically just take those and turn those, and they keep making money on them via their back end sources. I mean,
Yeah. I mean,
what they're doing, man.
It sounds a lot like the buy here, pay here car sale model.
It's the same damn thing.
It's
the same thing in a big level.
Yeah, they don't need to make money on the cars because they make all their money on the finance side.
Absolutely. That's exactly what it is.
Which, yeah. I think maybe we talked about that in Cabo.
I think we did. I think it was a hot tub talk.
Yeah. It was, 12 margaritas deep or something silly, but it's coming full circle now. But yeah, absolutely. Back in my banking days, we financed some of the big players in that, and it was shocking to see that they didn't care about the car sale.
Not at all.
There was all the finance game.
Yeah. Well, the biggest thing that I've learned, and a lot of people understand this, but a lot of the, people that don't understand money don't. You do. But the funniest thing you'll learn is when you really study banks and you study the entire financial system, and you look at all the loans that they make, whether it's loans to countries, whether it's loans to big developers. The first and foremost thing you have to understand about banks is they don't care if they ever get their principal back. It's not their money anyway. All they care about are the monthly payments. And when somebody can't make those monthly payments, what do? They find a creative way to give that person more money, even though they know they're never going to get the money back. Imagine that if you know that banks don't ever want their principal back, they just want the payments, and you knew how to leverage that. Do you know how dangerous you'd certainly be dangerous as hell. But read the book, Creature from Jekyll Island, I think it's called. Jackal yeah. Island. Read that book, and you'll learn all about how the banking system was created, how it operates, and it'll change your entire perspective on how money really works and how you can play the system within its own rules and literally just make millions and millions and millions of dollars.
Oh, it's unbelievable. And think about it this way: if you had $1 million that you didn't want to use, you just wanted to make as much money as you can and spend the money that you're making on a return basis. Okay, so you would not, just like Warren Buffett, you wouldn't want that cash back. Mm-hmm. You want that cash out there working. It only makes you money if it's out there working for you. So it's the same concept, right? If Chris, if you're paying me 10% on my $1 million, that means I got $100,000 coming in a year. When you give it back, it means I got to go out and find a new person to give it to. No, I want you having it, paying that interest so that I can use that money. I have that income coming in. So when it comes back to me, I can't, I've got to go and redeploy it. It takes time. I got to analyze deals. So it's the same concept. I think that's what you're getting at, right?
It is. And it really comes down to, anyone that's borrowed money from a private lender, the worst day for that private lender is the day you pay them their money back. They don't want their money back. It's almost like creating a crack addict, right? You borrowed their money and they got used to that cash flow. Then all of a sudden you want to give them their money back. It's like, oh no, I don't want it. Don't you have another deal? Can't you find another deal? Like, I don't want it back. Well, if you give me it back, because I know I got to take it back, you got to find me another deal. Like, that is reality.
Well, cool, man. Well, I greatly appreciate you coming on. I think it was a fantastic episode. I think we got some really good takeaways, and the listeners out there should have some big nuggets there to take home and implement and try and get out of their own way and get out there and rock it. So I greatly appreciate you coming on and giving us some. Hey guys, as always, this episode of the podcast is sponsored by Bottleneck Real Estate Virtual Assistants. These guys are fantastic. We've been using them for years in our business. They've really helped us scale. Hopefully you guys like them as much as we do. If you want to get in touch, it's bottleneckrealestate.com, bottleneckrealestate.com, and I think you will be very happy with them. If you got some good quality content out of that, if you think it would help anybody, please go to iTunes or SoundCloud or whoever you're listening to this on and subscribe to the podcast. Also, please give us a 5-star rating. It really helps get us out there. If you do subscribe and give us a 5-star rating, take a screenshot of it, email it over to info@robertheyder.com, Robert, Heyder.com, and register for you guys to win a free one-on-one coaching session with myself or one of our guests. They were nice enough to give up some of their time, so thank you for that. Also, please follow us on social media, Robert_Heyder at Instagram, Robert_Heyder at Instagram. We'll drop some really quality content there. Also, I almost forgot, if you guys want a free commercial real estate guide and commercial real estate analysis tool, just go to the website, robertheyder.com, fill out that brief little form, and we'll email that over to you. It's a really, really good tool just to be able to analyze deals quickly, understand kind of what's going on, see if it's actually a deal. All right, guys, thanks. Until the next one.